Midterm elections, classically, they are negative years. From a socioeconomic standpoint, people have been a believer that everything was going to be okay, right? And that's why we haven't seen the food prices go crazy, why we saw a big crash from the highs in the metals. And oil has always been my X factor. So what I'm going to look for right now, and that's going to dictate everything to where I position myself over the next few months, is how much does that sentiment of everything's going to be okay switch to it's not okay. We're kind of screwed right now. We can't end this war. We don't believe that this war could end. We don't believe that we're going to see oil prices come down anytime soon. We can't afford to eat. That's the key. It's going to be like a switch. And the switch has been by the dip. Everything's great. The war's going to end. Trump's in control. It's all good. You know, there's lack of regulations. Everything's awesome. And just don't worry about it to, uh-oh. And that's when we've got to be back in the gold market.
Hey there, everyone. Dave Kettler here with Market Misbehavior, and welcome to our latest episode of the Market Misbehavior podcast. Today, we're catching up with Mish Schneider. Mish is the Director of Trading Education at Market Gauge, based in Santa Fe, New Mexico. I've known Mish for a number of years. We actually met at a money show a number of years ago in Las Vegas, hit it off and have kept in touch. I've had the pleasure of interviewing Mish many times over the years. I think of Mish as a trader, as an educator, and as a thoughtful market practitioner. Today, we're going to talk about her economic modern family, sort of a unique way that she thinks about key areas of the equity and other components of the financial markets as characters and tracks their performance as a way to measure the strength of the markets, the strength of the economy, and where opportunities could lie. I will let Mish share with you some of the members of the economic modern family, some of the signals that they are sharing today, and sprinkled along the way, good healthy dose of investment wisdom. So please enjoy this interview with Mish Schneider of Market Gauge. Mish, it has been way too long. Welcome back to the show. It's good to see you.
My goodness, we've known each other for a very long time, so it's so good to catch up with an old friend and also a brilliant market technician.
You're kind to say it, Mish. We have a lot to talk about for sure. I mean, the markets I feel like, has had a new ingestion of volatility. So as always, I know my viewers and listeners are going to be very thankful for some Mish perspective to try to make sense of everything that's going on. But I'd love to start with this because when I think of you, your process is very unique and you've had a way of describing market conditions in a pretty unique way. Most investors, certainly that watch the show, kind of start with the S&P 500 and then branch out from there. You almost seem to do the opposite. You start with the economic modern family, and then you let those relationships kind of tell you the story. How did you come to believe that the market should be viewed through that particular lens?
Well, basically because I wanted to be able to gauge the U.S. economy more than just the global impact that the technology companies have or the NASDAQ leaders have. I felt that looking at the Russell 2000, which is the grandpa of the family, and also what I would consider to be the grandpa of the U.S. economy, always gave me a perspective. Not so much that I wouldn't trade the S&P 500 or the NASDAQ, and I wouldn't see the incredible divergence between the two indices, but more that it would give me either a green light that things were either rotating or continuing to do well, even if Gramps wasn't doing as well as the S&P. And even more importantly, B, that it would give me very often an early warning that the S&Ps and NASDAQ were kind of floating off into space, sort of disingenuous from the rest of the reality of the market, and Grandpa would relay that. So this year's been real interesting, though, because Grandpa's kind of been leading. And what does that tell you?
I was going to say, Grandpa Retail, I don't know when I've spoken to you before. It's been very rare that has been the story. If we could, let's go through some of these economic modern family members and sort of what's been happening recently, what that tells you about the conditions, starting with small caps. I mean, small caps have been sort of a chronic laggard and now starting to do well. What's the message there, do you think?
Well, the good news was that the IWM, which is the grandpa, was really, I think, reacting to a lot of the policies that were enacted with reshoring and promoting manufacturing. Obviously, our administration targeting certain companies that were producing in the United States. And it reflected a certain optimism that the US economy was going to grow. And even if it didn't necessarily grow as much as we would have liked, certainly compared to other economies, it was growing better. And I think that's why we saw so much interest, because those 2,000 companies in the Russell 2000 are, yes, small cap, but also all represented in the United States. Whereas if you take a lot of the NASDAQ stocks, not only are they like Apple doing a lot of the development in China in terms of putting the parts together, even though we've been trying to bring that back home, or Tesla, for example, they had a more international presence. So it was great to have technology lead for as long as it did, but I wasn't necessarily upset, as many other people were, when I started to see the whole technology space roll over while the small caps started to shine. And if we go right to date today, as we are speaking, we have the NASDAQ under the 50-day moving average. We have the S&P 500 under the 50-day moving average. The Dow is doing well, obviously, because of the defensive companies like Lockheed Martin. And Gramps is sitting, IWM, on the 50. So it's actually, for a long time, years, outperforming. Whether that sustains remains to be seen. But what it does is, instead of worrying about the S&P and the NASDAQ so much, I think it'll give you a really better gauge on what people are feeling about our own economy, if it holds, or fails from here.
It's and I feel like we're so sort of programmed to think of technology as the leadership in this market, because it's been that way for quite some time. One of your other characters represents the semiconductor space, obviously vital to most of the optimism we've seen here in 2026. We've seen some initial rollover in things like NVIDIA and Broadcom. Now we're seeing others sort of chop around. Where do you think we're at in sort of that semiconductor cycle? And how do you think about opportunities there in some of the previous leadership versus some of the emerging strength we're seeing in other areas like financials, industrials? How do you balance that?
Well, yes, it's been all about tech. And we've had some fun with our sister semiconductor character through the years, comparing her basically to Wonder Woman, because her sector was literally carrying everything: the market, the economy, and of course, all the innovations that we've seen through AI and the need for chips and the AI build out data centers, et cetera, et cetera, et cetera. But everything is cyclical. So in terms of how I see it, I know I've been, Dave, you and I go way back, not just together, but, in markets in general, decades. And one thing you have to know is that everything cycles through. Yeah. And you can't constantly have tech leading everything, because we saw exactly what happened. CapEx got out of control. People don't want data centers in their backyard. The competition from China certainly was going to be a factor at some point, and now here we are with memory chips and things like that. And so we know that means that the incredible run had to be over. But that's very different on whether or not it's done, number one. Number two is, what's going to be the ultimate impact to the economy? And that's what we're trying to discover through earnings right now. And number three, does that necessarily mean that if it can at least correct and consolidate at a point, like we've seen so many of the other sectors do through the years, does that mean the fun is over for the things that have been doing well this year?
Mish, and I appreciate you summarizing, I think, beautifully where we're at in that technology cycle, and certainly all eyes will be in that group here in the coming weeks through earnings. An area that I often, whenever I see it start to emerge in a position of strength, the back of my mind, I say I need to connect with Mish and see what her take is on this. Agriculture, right? When I'm looking at soybeans, I'm looking at wheat. These are some of the more emerging areas of strength that we've seen here. Talk to me about the performance of agriculture kind of year to date, and what's changed that's really caused this resurgence in an area of the market I think a lot of people have probably not been thinking so much about.
Well, right. And what makes the agricultural market so interesting right now is that we have a reflection of inflation, obviously, based on higher oil prices on one level. But on the other level, we're not really seeing the classic inflationary signs yet, which people probably would think, oh, how could she say that? All we're talking about is inflation. We're still relatively in a stagflation environment because we haven't seen this tremendous growth. We're starting to maybe if things hold up. So bringing it back down to the food levels, I mean, certainly oil prices, what's happening with the Iranian situation and the Strait of Hormuz, and even Ukraine, Russia, which is still back there, which we shouldn't forget about because I can't imagine Putin's going to stay quiet forever as Ukraine keeps lobbing drones at them. All of this was impacting food prices through fertilizer. And then what happened this year on top of the geopolitical situation is that we're in an El Niño year, which is a heavy drought year. And we're starting to see drought, not just through some of the regions in the United States, but from other growing areas like Argentina and Brazil that make a lot of commodities, right? So you add that to the mix. And what you have now is a nuanced inflation through food, still relatively cheap compared to where, let's say, tech has been, right? And I always argue, you may not be able to live without your cell phone, but you don't have to buy the next Apple, but you do have to eat. So I think this is really putting us right now in a very interesting situation. If we just look at it holistically, the whole, not just world, but let's go down to the US, which is there's still a level of optimism, but there's a tremendous number of people in this country that are struggling right now. And these food prices look like, if you look at the wheat chart, if you look at the soybean chart, and you look at the corn chart, they have just broken out. Will we see some potential consolidation over the next few weeks? Yes, and I would consider that to be very bullish. If you look at DBA, that thing is just rocketing right now, and I don't see any stop to it except, again, if you go through a period of consolidation, which are buy opportunities. So what is that telling us? That's telling us that food is probably going to get more expensive.
When you think about, and I'd love to just ask you further about this, so it was such a great summary of some of the action that we've seen. When you think about some of the agricultural commodities, right? I mean, there's sort of the grains, things like corn, wheat, soybeans we mentioned. There's, other soft commodities, coffee, sugar, cocoa, livestock you kind of throw in there as sort of these different related commodities. How do you think about the DBA as like broad exposure to agriculture versus making direct plays on some of those themes? Is there a set of conditions where you think it's more of a broad commodity play or soft commodities versus digging into those? Or is it more of a technical thing, right? The charts tell you to lean into one area versus the other.
Well, I don't have to tell you, Mr. Keller, that I think that price precedes the fundamentals, and the chart kind of tells you what's up before sometimes the news does. I mean, we could certainly take oil as an example of that, and gold and silver, for example. But sticking to the food and DBA, that's a great question. Essentially, what I've been doing is I've been buying mainly DBA, and you have to have a pretty sizable position in DBA because it just doesn't move. It's kind of a slow mover. You're not going to get the volatility, or at least you don't want to see the volatility. Whereas if you go to the futures market and you're looking at the individual commodities, if you're going to buy soybeans, wheat, or corn, well, you certainly just got a nice volatile move up. But we know that can also crash because they're extremely emotional. We could say manipulated. They're highly speculated. So I like DBA as that exposure. However, my favorite outside of that to trade is sugar and really cane. I could trade sugar futures easily. That's actually the first trade I ever made in my entire life was sugar futures. But cane is a good for us older investors, older time investors, I should say, not older in age, but just because it exposes you to sugar and some other assets, obviously, but sugar mainly. So let's go back to what I said before, is we're looking at inflationary things, but not necessarily hyperinflation, because sugar's always been my key barometer in that. The dollar, which is strong, so we're not seeing it there. The gold to silver ratio, which was looking very inflationary for a while, now has creeped back up in favor of gold. It's when silver starts going crazy that you see inflation. And the third one, of course, would be sugar. So the reason why I'm mentioning cane is because I'm trading it almost as a separate entity to the DBA. All those factors are making all the agriculturals go up. And by the way, cotton even all of a sudden is starting very bullish. Lumber looking bullish. The only one in that whole complex that doesn't look so great right now is copper, which is not in DBA, but in terms of just,
Yeah.
Copper looks like it may have topped, but we can get back to that. If sugar right now, which has been up, if it goes up back over 15 cents and stays, it tells you two things. It tells you that people are really starting to hoard food that is less expensive than the great whole foods that you get from wheat, corn, and soybeans. Sugar's in everything. It's been during the hardest times, something that goes up. People fight in other countries over the last pound of sugar on the shelf. And so I've always considered that to be, if you really want to see chaos ensue on a broader level, where it really starts to affect day-to-day life, not just in this country, but certainly you'd probably see it more in other countries first. Watch those sugar prices.
That is really thoughtful. And I no one is accusing the American diet of being undersugared. So I think that's an important area certainly to be following. I mean, how do you make sense of a market right now, Mish, that is so macro oriented, right? Because, conditions in the Middle East re-escalate. Just in the last week, we've seen this. All of a sudden, crude oil spiking, Brent crude above $100 a barrel, food prices, right? Like everything starts to rotate. But you mentioned earlier, I feel like if there is some peace deal that's signed tomorrow, you could see all of those just whipping back just as quickly. How do you manage the excessive volatility, the excessive risk you're taking on in this particular environment? Is there a different way that you sort of think about the risk side of the equation, or is it more just stay disciplined and make sure you have your exit strategies well defined?
Well, I'd say it's probably both.
Yeah.
Certainly when you're trading any commodity, whether you're doing it through an exchange traded fund or you're doing it in the futures market, as an old commodities trader, you don't marry any position because it can break your heart. I mean, it's called natural gas, the widowmaker, but I've seen that could be applied to pretty much any commodity that's traded. And lately, you could even apply it to some tech stocks. I mean, if you came in long Tesla, you're not feeling too good today. But so here's how I'm looking at it, and I'm trying to be very clear because I don't want to get into any kind of a political bent. It's more of a socioeconomic framework that how I'm looking at the market right now. And there's a couple of areas. Number one is, yes, we just saw that we had a nice move in the in the Russell small caps. Transportation went and made a new all-time high. Okay, how could I be bearish when transportation's doing so well? The financials, you mentioned it at the top of the show. Yes, KRE, which is one of my family members, regional banks did well. Obviously, the big banks had great earnings. All of this has told me that from a socioeconomic standpoint, people have been a believer that everything was going to be okay, right? And that's why we haven't seen the food prices go crazy, why we saw a big crash from the highs in the metals. And oil has always been my X factor. So what I'm going to look for right now, and that's going to dictate everything to where I position myself over the next few months, is how much does that sentiment of everything's going to be okay switch to it's not okay. We're kind of screwed right now. We cannot end this war. We don't believe that this war could end. We don't believe that we're going to see oil prices come down anytime soon. We can't afford to eat. We start to see it in terms of the modern family, XRT, particularly granny retail, which has come down a lot, starts to crash more. The financials even go with it. Grandpa Russell, as we mentioned before, doesn't hold the 50, and transportation spikes up because it caught everybody short. But now, of course, you do have some defense contractors in that sector. But outside of that, we saw some bad earnings in airlines. I mean, that's the key. It's going to be like a switch. And the switch has been by the dip. Everything's great. The war's going to end. Trump's in control. It's all good. There's lack of regulations. Everything's awesome. And just don't worry about it to, uh-oh. And that's when you got to be back in the gold market. I've been starting to buy gold down here again. I haven't been in it in a couple of months now since the crash. That's when I'm looking at sugar. Like I said, the things that are more emotionally reactive reactive to things aren't okay. And you don't necessarily want to be long a lot of equities at that point either.
Yeah, it's really, really interesting. There are a number of things I want to chase down from what you just described. There was a great summary of how to think about agricultural commodities and the broader commodity space. When you're talking with investors or advisors, how do you think about from an asset allocation perspective, like where does agriculture kind of fit in? I mean, for some, I know gold, to your point, that's sort of like the safe haven. That's a defensive bet you might be making. But is there an argument to be made for, some sort of core exposure to that area? Or is it more cyclical? It's whenever the opportunity's there, that's when you lean into it, right? Is it more of an opportunistic play, or is it something that should be thought of as more of like a core allocation? How do you think about it?
Well, if you would have asked me 3 weeks ago, I would have said gold hasn't bottomed yet. But now, 2 weeks ago, I started buying gold down around the 4,000 an ounce level. Not so much because of the technicals. I mean, yes, it's consolidating now between 4,000 and I think it got up as high as 4,150 yesterday, and now it's back down under 4,100. So you've got some numbers, and you always want to look at the chart. But like I said, I can see that switch has gone from, okay, high interest rates and strong dollar, gold's out of favor, to who cares about high interest rates? Also, who cares about a strong dollar? Because at this point, this is something that even the Fed will not be able to control either. And when you start to get more into a chaotic, that switch, like I said, going the other way, you have to have an allocation to gold. I've seen it over and over and over again. And then when the psychology changes, of course, you can use the charts, you can look for topping patterns, you can have trailing profit targets, what have you. But it's really interesting. You can almost, I guess I can almost feel the shift when you look at the charts. That's the beauty of charts, is that it's predictive when you start to understand patterns that keep repeating.
No, Mish, that's such a great summary of the agriculture space and of commodities, and I appreciate particularly talking about gold. That $4,000 an ounce level has started to hold for sure, and it's something I know we've been reflecting on as well in our own work. One of the other characters in the economic modern family, you just alluded to it, transportation. And we've seen kind of mixed results in transports, but the IYT is kind of hanging in there pretty good. We've had earnings this week from some of the railroads, like CSX is making a new high today. Talk to me about that strength in transportation. What does that mean relative to some of these other themes that we've talked about? And is that still an area where you look at opportunistically?
Well, it may not be quite as old as Charles Dow, but he was onto something. Of course, it was much more simple back then than it is now, because just the modes of how things get across have changed with the internet and in particular, and now AI, of course, and drone technology. I mean, none of that existed back in the day. But the idea of it was measuring the economy through how robust goods, services, and people were transported is important. It is important. And that's why I can't throw in the towel just yet, because we are seeing railroads are doing well. Mm-hmm. And what are they doing? They're carrying goods from one place to another. People are still ordering things, and people are still going places. Although, like I said, the recent airline earnings may not have been as good, because I think we saw today that AAL was not doing well today. I haven't actually looked at the stock, but I saw it sort of come across my screen. And so, transportation is another beautiful way besides the small caps. There's three. Stanley Druckenmiller calls them the inside sectors of the U.S. economy, and he doesn't even know about my economic modern family. I wish he did. But he talks about the small caps, the transportation, and the retail as the three most important areas to watch to get a gauge of the U.S. economy. So we've seen IWM, small caps do well. Transportation went to new all-time highs. It's kind of reversing today based on those airline stocks. And Granny Retail actually made a new high and then sold off. Looks like now we're going to be watching those moving averages. So we're at another precipice. This is why I'm saying with a switch on or off, those three areas, if they can't hold up here, I think that's kind of telling you that August is not going to be so much fun. And we haven't even gotten into things like the debt ceiling yet and all the other things that have happened in August. That if you go back as far as we go back, we know August can have huge crashes when they shut down the government. Although that seems to be less of an impact than it used to be. But the idea is that we have to keep printing money to pay for our rising debt. And so you'll see it in those sectors first. And that's why it's so important to look at them. Regional banks, by the way, in March 2023, when everybody was so bullish, crashed. And then the whole market crashed. So that's why it's so important to look at these things. And believe me, my eyes are heavy on IYT, XRT, and IWM more than anywhere else right now.
And honestly, Mish, you and I have spoken regularly for many, many years. And I remember from the first time we met and you explained to me, this idea of the economic modern family, you just kept reinforcing things that I feel like just made so much sense. And since talking with you and following those key, indicators, it's hard to not get a good read on economic conditions for sure. You'd mentioned just briefly about some of the seasonality, right? We're kind of getting through July here, getting into August, heading toward the fall, which usually in a midterm election year, not often particularly strong. How does the seasonality play into your thinking, through Q3, and how does that inform your approach today?
Well, I just talked to a gentleman I did another interview with. It was like, well, that they're going to put boots on the ground in the Middle East right after the midterm elections. And I'm wondering, why would they do that after? Well, wouldn't they do it before to try to show some kind of a confidence that we've got this thing under control? And I think that makes this midterm elections, classically, they are negative years. I know this is going to go a little woo-woo, but I'm a big student of what the Chinese astrology is for any particular year. This is the year of the fire horse, double fire. Last time we had that was in 1966, which is interesting. If you look at 66 and now, we were just getting escalated in the Vietnam War back then. There's so many interesting comparisons to 66 to now. The Russians got to the moon before we did in 69. Now we have China advanced with their rocketry. The first artificial heart was created in 66. Here we are with biotechnology, so much innovation happening there, on and on and on. But the point is that if you just look strictly at the numbers, seasonality, it wasn't a good year. I think the market closed down about 16% at the end of that year. And here we are heading into an extremely volatile situation. Lots of fire, if you want to look at that fire sign. So I would be happy to be wrong, but I'm going to watch IWM, IYT, and XRT. And if they go down, it's going to be hard to stay friendly to the market. And if IWM gets back over 300, it's going to be hard to make me negative, no matter what's going on.
Mish, when I think about 2026, I'm sure for some investors, it has been a painful year at times, especially if you hold on to stocks like a Palantir and NVIDIA while they're working and you're a genius, but then you keep holding on when they don't work. And all of a sudden you just feel like an absolute dog just like that. How have you learned to stay flexible and recognize when things shift? Because I feel like this has been a wake-up call for a lot of traders that have just been holding on to the previous leadership way too long. So what do you do to remain flexible and recognize when the evidence shifts?
Well, first of all, I'm not a buy and hold trader. That's not my MO. It never has been. I believe that you can do very, very well catching the momentum in something, but taking your profits along the way up. That's the whole basis of our quant models. Is they get in, they have an X amount of risk, about a 15% risk generally from the entry point, and then they have these tranches of taking profits with trailing stops. And I think if you just always trade like that, you can catch it. I mean, I caught silver from literally $22 an ounce. We got out the day it hit $100 an ounce. You of all people can appreciate this. I said to Keith, I think we should sell some up here. And he goes, oh, it's probably going 150. And I'm like, no, you're just breaking every rule that we know. Take some off. And of course, it turned out to be the high. Now, I'm saying that I'm a genius and he isn't, but I'm saying This is the what mental. You have to understand your own genetic, your wiring before hope, fear, and greed. I mean, that's the biggest thing of all to stay in this game for as long as you and I are in, is knowing that you can't hope something goes up. You can't be afraid to buy something if you have a good stop in mind, and you can't get greedy if things are just continuing to go your way, because everything comes to an end. Murphy's Law.
Easier said than done, but I appreciate that so much, Mish. That's well said. Hey, listen, before we go, you'd shared how you've actually started to transform this economic modern family, these characters that I feel like you've been thinking about and talking about for many years. They're actually coming to life in a new way. Can you share with us this new series that you're working on, and what are you trying to accomplish with it?
Well, first of all, the series is called Trades of Our Lives, after days of our lives. And we're making it like a soap opera. So I'm sure that some of you might be familiar with what's really happening in filmmaking right now is going to short form vertical format. There's a company, it's a Chinese company, but it's called Reel Shorts, REEL Shorts. And essentially that's what they're doing, is they're building vertically a series. So the fact is that for the Gen Z crowd, but even for, any generation, short form vertical format keeps you entertained and keeps you engaged for 45 seconds. That's it. I mean, that's pretty much the average attention span anyway. So that's kind of what we did. We took the economic modern family. They're all characters that I created a decade ago that now have been generated through AI images. So Granny still looks like Granny, but she looks a lot better than she did as a black and white cartoon. And we're making them into this soap opera in this format to teach people about trading. Financial literacy, everybody says it's lacking. Trading literacy, even more. Because when I talk to parents, they go, oh, well, my kid would never know how to balance a checking account. Well, your kid's never going to have a checking account. So what's more important is your kid can open up a Schwab account at 13 or open up a Robinhood account and is going to start trading. There has to be some literacy there. So that's what we're doing. We're taking a course, an A to Z course that was created by Market Gauge years ago, and we're following that curriculum through this dramedy, through this short form Trades of Our Lives. You can find it on YouTube at The Economic Modern Family. You can find it on Instagram. You can find it pretty much everywhere. So, and it's been a lot of fun, and it's great.
I was able to catch some of the early episodes, Mish, and it's really well done, and I appreciate it. Honestly, there's a lot of great insights in there, but in a very accessible way. People should know, by the way, that when you run your own firm, which you and Keith and your group does, you can pretty much select whatever title that you want. You told me years ago, I'm director of trading education. So I know there's always been a great educational angle to what you've done. And I think you've helped a generation of traders hopefully make better decisions. So thanks for continuing that with this new initiative. Mish, always a pleasure to catch up with you. Great to see you. We will make it less of a gap until the next time you come on the show. But for now, I say thanks so much for joining us.
Oh, thank you so much for having me, Dave. It was really wonderful to catch up with you.
Oh, it was a lot of fun. Thanks again to Mish Schneider from Market Gauge joining us on the show today. As she alluded to, right, she got her start trading ag and trading agriculture commodities, and so I always enjoy talking with Mish about metals, about energy, about soft commodities, and she knows way more about everything that I just said than I know I ever will. But it's always such a pleasure to think about that. Really appreciate her comments about the DBA, about the different parts of the commodity complex. I think for a lot of investors and a lot of traders, commodities are sort of like this kind of general catch-all bucket, but it's actually a pretty diverse group of things, right? And so I really appreciate her way of talking through some of the different components in there. Interesting thoughts about sugar, interesting thoughts certainly about crude oil, interesting thoughts about gold and silver as well, which I was definitely jotting down. That discussion of the economic modern family, Mish shared that with me years ago, probably soon after she was coming up with this idea that, it's Grandpa Russell, Granny Retail, there's biotech, there's sister semiconductor, transportations, There's a new addition, crypto, as one of the members. But again, when you think about what are the key things we should be tracking to recognize where the opportunities are at a particular point in market history, looking at those sort of economic modern family members makes a ton of sense. Those are pretty much the key things you want to stay on top of. And I have definitely internalized that in my own process of making sure that I routinely am checking in on each of those different areas of the market. Also really helpful, I tried to pepper in some sort of timeless, sort of thoughtful ideas about, or questions to just tease on Mish's thoughtful way of approaching things. And I loved her take on, basically looking at the charts, right? Finding the evidence, finding where the opportunities are. And, when I've ever interviewed Mish, she's always had a good sense of where everything is. And I know that's because she has great routines of checking on all of these different areas of the market and following them closely, and then sticking to the discipline, right? The word discipline popped in my head as I was talking with Mish there about all the areas that she's looking at. Great take there overall. Thanks again, Mish, for coming on the show. We'll certainly want to circle back with Mish here later in the year as the midterm elections sort of evolve, as we see how things play out in the Middle East, as we certainly track the excessive volatility in the commodity space, especially agriculture, having renewed strength here in July of 2026. By the way, if you want to improve your ability to follow trends, to remain disciplined, and to have good market awareness, as I think Mish aptly illustrated today, our Market Misbehavior Premium memberships may be a great opportunity for you to supercharge your own investment process going forward. 3 great benefits to the premium membership. First off, we'll teach you all about technical analysis and behavioral finance through our virtual courses. Second, we have members-only reports to keep you informed, to keep you aware, and help you understand how we can apply technical analysis day in, day out. Finally, you'll have full and immediate access to our member community, where you can ask questions, where you can learn from other like-minded investors. And I'm in there giving a market update pretty regularly to share some of my thoughts as we go through each trading day. All of that can be yours today if you go to marketmisbehavior.com/premium. I hope you will check it out, and we'd love to have you as a premium member today. That'll do it for today's episode of the Market Misbehavior Podcast. My name is Dave Keller, reminding you it's always a good time to own good charts. Take care, folks.